Welcome back to the Investor's Library. We always try to crack open those must-read books for anyone who wants to level up their money game.
Absolutely.
And today we're diving into a classic,
Oh, yeah.
Money, Master the Game by Tony Robbins.
It's a good one.
It's packed with advice from Wall Street giants. And even though it came out in 2014, we're going to try to connect those insights to the market that you're facing right now.
Yeah, that's key because, even though the markets are always shifting, the fundamentals of smart investing don't really change that much.
Exactly. Now, Robbins starts off by painting this picture of how much the financial world has changed for everyday folks. Remember those cushy pensions our parents talked about?
Oh, yeah?
Gone for most of us.
Yeah.
Replaced by 401ks
Yeah.
that put the investing burden squarely on our shoulders.
Yeah, and it's not just that. People are living longer, Social Security's future is uncertain, and suddenly we're all supposed to be mini Warren Buffetts.
Right.
No wonder so many people feel lost when it comes to their money.
Robbins knows that feeling.
Yeah.
That's why he created this 7-step plan to take control of your finances.
Yeah.
Even if you don't have a finance degree.
Right.
He even has a free app to help you actually implement the advice.
That's great.
But here's where it gets really interesting. He doesn't just talk about picking stocks or interest rates.
Right.
He goes deep into the psychology of wealth.
Yeah, that's what often trips people up. It's not about lacking information. It's about our own hidden beliefs and fears that sabotage us before we even start.
He calls it the psychology of wealth. And it's honestly one of the biggest takeaways from this book. He talks about the 6 basic human needs, things like certainty, variety, significance, connection. What's fascinating is how these needs, especially the need for significance, can actually drive us to make bad financial choices.
Think about it. How many times have you bought something you didn't need just to impress someone or feel like you made it? Robbins uses the example of Julie, a screenwriter who struggled financially because she unconsciously linked money to greed. She grew up with a father who always stressed about money, so she developed this belief that wealth was inherently bad.
It's a great example of how our money story, the beliefs we form early on, can really hold us back without us even realizing it.
Absolutely. And a big part of Robbins' message is about rewriting that story. He introduces this idea of a freedom fund. It's not just about saving, it's about building a money machine that generates income even when you're not working.
It's like having your money work for you instead of the other way around. He shares inspiring stories of regular people who achieved this even without huge salaries. Theodore Johnson, a UPS worker who diligently saved 20% of his paycheck. Grace Groner, a secretary who turned a small inheritance into millions.
These stories are meant to show you that anyone can build wealth, even if you're starting small, if you have the right mindset and the right strategies.
And speaking of strategies, Robbins goes on to debunk some of the biggest myths that keep people from achieving financial success. Myth number 1, you need a huge income to get rich. He uses John Templeton as an example, a guy who turned $10,000 into billions by investing in what everyone else thought were doomed companies during World War II.
Templeton understood that markets move in cycles, and that often the best time to buy is when everyone else is panicking. Think about how this applies today. Are there emerging sectors or companies that are being overlooked because of short-term fears or negative news?
Myth number 2, fees don't really matter. This one's particularly relevant now with so many low-cost investment options available. Robbins rips into the hidden costs of mutual funds, and he even highlights how some seemingly low-fee 401k plans can be riddled with hidden expenses.
He wants you to be a savvy investor, not just someone blindly trusting whatever a financial advisor tells them. Remember, even a small percentage difference in fees can add up to a huge amount of lost money over time.
Myth number 3, reported returns are what you actually earn. Robbins pulls back the curtain on how mutual fund reporting can be misleading, urging investors to really understand what they're truly earning after fees and taxes are taken into account.
It's about becoming an educated investor, someone who can read between the lines and make informed decisions.
Myth number 4, your broker works for you. He highlights the key difference between a broker and a fiduciary. A broker might be incentivized to sell you products that earn them a commission, even if those products aren't the best fit for you. A fiduciary, on the other hand, is legally obligated to put your interests first.
This is crucial to remember, especially with the rise of robo-advisors and online investment platforms. Always do your research and understand who you're entrusting your money with.
Myth number 5, retirement is just a 401k away. Robbins digs into the pitfalls of high-fee 401k plans, encouraging readers to fully understand the fees they're being charged and to explore alternative retirement savings options. He even shares the story of Robert Hilton Smith, an economics PhD, who discovered that his seemingly reasonable 1% 401k fee was actually hiding 16 other fees eating away at his retirement savings.
It's a cautionary tale that highlights the importance of being proactive and informed when it comes to your retirement planning. Don't just assume that your 401k is doing all the work for you. So we've talked about the myths, but what does Robbins actually recommend doing? Well, he lays out those 7 simple steps, which are basically a roadmap to build wealth over time.
Okay, let's walk through them. Step 1 is deciding to become an investor, to actually take charge of your money instead of just letting it sit there.
It sounds simple, but it's a huge mental shift. You're going from being a passenger to being the driver of your financial future.
Step 2 is figuring out how much of your income you'll save and invest. Robbins calls this your freedom fund, and he stresses automating it as much as possible.
It's like paying yourself first. Set up those automatic transfers so the money goes straight into your savings or investments before you even have a chance to spend it.
Then step 3 is creating a financial plan. How much do you need for security, independence, and what Robbins calls freedom? He gives you a framework to figure out these numbers, taking into account your income, expenses, goals, and dreams.
It's about having a clear vision of where you want to go financially so you can create a plan to get there. Step 4 is all about becoming an insider, understanding the rules of the game so you don't fall prey to those costly traps Robbins was talking about.
This is where he dives deep into those myths we just discussed, exposing the tricks of the financial industry. He wants you to be informed and empowered, not just blindly trusting anyone with a suit.
Step 5 is building a lifetime income plan, turning your savings into a steady stream of income that'll last you through retirement and beyond. He talks about strategies like annuities, especially those fixed indexed annuities he's a fan of.
Then we get to the juicy part. Step 6, invest, like the 0.001%. This is where Robbins shares those amazing interviews with billionaire investors.
It's like getting a peek inside the minds of people who've actually mastered the money game. We'll break down their best strategies and tactics later on.
And finally, step 7 is mastering the mindset of wealth. This goes beyond just numbers and strategies. It's about developing the beliefs, habits, and emotional intelligence that support long-term financial success.
Robbins believes that true wealth is about living a life of purpose, meaning, and abundance, not just about piling up money.
So those are the 7 steps, but let's zoom in on one of the most powerful concepts in the book, compounding.
It's like magic, but for your money. Einstein even called it the 8th wonder of the world. It's how small amounts of money invested consistently can snowball into significant wealth over time.
Robbins uses the story of 2 brothers to illustrate this. The brother who started earlier, even though he invested less overall, ended up with way more because of the power of compounding.
That's the key takeaway here. Start early. Even if you can only invest a little bit each month, the sooner you start, the more time your money has to grow exponentially.
Now let's talk about Robbins' approach to asset allocation. He advocates for a 2-bucket system, a security bucket and a risk growth bucket.
The security bucket is for those sleep well at night investments, things like cash CDs, money market accounts, maybe short-term treasury bonds. You're not looking for massive returns here, just stability and preservation of capital.
Right, it's about protecting the money you absolutely can't afford to lose. Then you have the risk growth bucket. This is where you allocate money to assets that have the potential for higher returns, but also come with more risk.
Think stocks, real estate, potentially even things like cryptocurrencies or private equity if you have the resources and risk tolerance for it. The key is to find a balance between these 2 buckets that aligns with your individual goals, risk tolerance, and time horizon.
Robbins emphasizes that the younger you are, the more risk you can typically afford to take. But as you get closer to retirement, you might want to shift a larger portion of your portfolio to that security bucket.
Now, finding truly secure investments in today's environment can be tricky with interest rates so low. Robbins even shares an example of how his own advisor found a unique opportunity in a residential real estate loan to help him achieve that stability within his security bucket.
It's a good reminder to be creative and think outside the box, especially when it comes to protecting your capital. All right, now let's get to the part. I know everyone's been waiting for the investment strategies used by those billionaire investors.
It's like getting a masterclass from the titans of finance. Robbins interviewed 12 of them, extracting their best insights and principles for building wealth.
We'll start with Carl Icahn, the corporate raider known for his aggressive style. Robbins calls him the most important investor in America and highlights Icahn's focus on what's called shareholder activism.
Essentially, Icahn believes that many companies are poorly managed and that shareholders need to take a more active role in pushing for change. He buys large stakes in companies he believes are undervalued or mismanaged, then uses his influence to advocate for changes that he believes will benefit shareholders.
It's a high-stakes game, but it's worked remarkably well for him. Now let's switch gears to David Swensen, the guy who managed Yale's massive endowment. His big takeaway is that asset allocation is the most important driver of investment returns.
He's all about diversification. His approach involves building a portfolio that spans a wide range of assets: stocks, bonds, real estate, private equity, you name it. He believes that spreading your investments across different asset classes helps to reduce risk and maximize returns over the long term.
He also warns against trying to time the market, saying that it's almost impossible to consistently predict market movements. He thinks most people are better off just staying invested for the long haul.
Then there's Jack Bogle, the founder of Vanguard and the champion of low-cost index funds. He believes that most investors are better off putting their money in a diversified portfolio of index funds rather than trying to pick individual stocks or time the market. And his track record speaks for itself. Index funds have consistently outperformed actively managed funds over the long term.
We can't forget about Warren Buffett, one of the greatest investors of all time. In this book, he gives his classic advice: a 90-10 portfolio, 90% in low-cost index funds and 10% in short-term government bonds. This simple approach has generated incredible returns for him over the years.
Buffett is all about patience and discipline. He believes in buying great companies and holding on to them for the long term, even when the market gets volatile. Now, for those who are a bit more comfortable with risk and navigating market ups and downs, there's Paul Tudor Jones.
He's a legendary hedge fund manager known for his ability to make money even when the market's crashing. He shares his famous 200-day moving average rule for risk management.
It's a simple but effective way to spot trend changes in the market and protect your investments during downturns. Basically, if the price of an asset drops below its 200-day moving average, it could be a sign that a downtrend is starting, and it might be a good time to sell or reduce your position.
This rule isn't foolproof, of course, but it's a valuable tool to have in your arsenal. So we've heard from these incredible investors. But one strategy in particular really stood out to me: Ray Dalio's all-seasons portfolio.
Yeah, it's all about building a portfolio that can thrive in any economic climate, not just when the market's going up. Dalio, the founder of Bridgewater Associates, one of the biggest hedge funds in the world, identifies 4 main economic seasons: higher than expected inflation, lower than expected inflation, rising economic growth, and declining economic growth.
And his all-seasons portfolio is designed to perform well in all of those seasons.
Right. The key is diversification across different asset classes that react differently to economic shifts. Think stocks, bonds, gold, and even commodities like oil or wheat. Dalio's approach is like having a financial umbrella that can protect you from various economic storms.
Okay, so how does this apply to someone like me who's not managing billions of dollars?
Well, the principle is the same, whether you're investing a few $100s a month or millions. It's about spreading your risk across different assets, not putting all your eggs in one basket. You might not need gold or commodities if you're just starting out, but the idea is to have a mix of investments that will react differently to economic changes.
So if one part of my portfolio is down, another part might be up, helping to cushion the blow.
Exactly. And remember, this is a long-term strategy. It's not about trying to time the market or pick individual winners. It's about building a resilient portfolio that can weather any storm.
Now, Robbins also talks about something that's particularly relevant as people are living longer, creating a lifetime income plan.
Yeah, it's not enough to just save for retirement. You need to figure out how to turn those savings into a reliable income stream that will last you for decades. Robbins highlights a few different approaches, but he seems particularly interested in fixed indexed annuities.
I've heard a lot about annuities,
Yeah.
but honestly, they always seemed a little confusing.
They can be, but in essence, a fixed indexed annuity is a contract with an insurance company. You give them a lump sum of money, and they guarantee you a certain stream of income for a specified period or even for the rest of your life.
So it's like creating your own personal pension.
In a way, yes. And the fixed index part means that your returns are linked to a specific market index like the S&P 500. So you have the potential to benefit from market growth. But unlike investing directly in the market, fixed index annuities typically have a cap on how much they can gain in any given year.
So there's less upside potential, but also less risk.
Right, and that's the key appeal for many people, especially those approaching retirement. You have the opportunity to participate in market gains, but your principal is protected from losses even if the market goes down.
That peace of mind is certainly valuable. And before we wrap up, Robbins circles back to something that's often overlooked in the world of finance: the importance of mindset and gratitude.
He talks about his own journey, how he went from struggling financially to achieving incredible success. And he emphasizes that it wasn't just about learning strategies or picking the right investments. It was about changing his mindset, his beliefs about money, and his overall relationship with wealth.
He encourages listeners to assess their own money story, to identify those limiting beliefs that might be holding them back, and to replace them with empowering beliefs that support their financial goals.
He also talks about the power of gratitude, arguing that a grateful mindset can actually reduce financial stress and help you make better decisions with your money. When you're focused on what you have rather than what you lack, you're more likely to make choices that align with your long-term well-being.
So it's not just about what's in your bank account. It's about your attitude and how you approach money.
Absolutely. True wealth, according to Robbins, is about living a life of purpose, meaning, and abundance. It's about using your financial resources to create the life you want and to make a positive impact on the world.
So there you have it, our deep dive into Tony Robbins' money. Master the game. We've explored the psychology of wealth, debunked some common myths, and uncovered strategies used by some of the most successful investors in the world.
Yeah, we've talked about the power of compounding, the importance of asset allocation, and the steps you can take to create a lifetime income plan. And we've emphasized the importance of mastering your mindset, cultivating gratitude, and taking control of your financial future.
Hopefully you walked away with some valuable insights and actionable steps you can use to build your own path to financial freedom.
Remember, it's a journey, not a destination. Keep learning, keep growing, and keep mastering the money game.
Thanks for joining us.
See you next time.